Boys.
Boys.
Sorry, gals. Boys, you both work in VC. Breakdown of basically all things VC to take you from hero to zero. Or zero to hero even. Oops.
VC, the money has to come from somewhere, right?
Yeah, but you just gotta match the vibe. If you believe in 2028, man, then that's all that matters.
I think vibes-based investing is where the industry should go. That sounds more fun.
When founders raise their money, they get excited and there's a conference and they want to spend 40 grand on a marketing stand, and it's like, that's not an important thing to do right now.
And I'm like,
VC is likely not going to steal your idea.
They
are not,
really don't care.
Really?
Don't care at all.
No.
If you're not transparent, that will really drag on the process more than it needs to be dragged on, which, time kills all deals as well.
Let them cook.
Burn the
them
bridges. This guy's never going to Sequoia. Hello and welcome to another episode of this CF Div Sweeps podcast with me, your host, Rory. With me today are two bulge bracket men. I thought you'd like that. Opposite me, we have a man who, where do I start? His achievements know no limits. Division 1 athlete, family office valedictorian. He's even rumoured to be in line for the next James Bond, but much more impressively,
Your
he's a
intros
friend of mine.
are too generous.
I was actually talking about Ken. No, Josh, how are you doing?
I'm doing well. How are you?
Yeah, I'm good actually, thank you. Yeah, I'm good. We've got this down. We're getting a lot better.
We are indeed.
And then to my left, or Josh's right, we have Ken, a man who thinks Blue Marlin is a place in Shoreditch or Ibiza. How are you doing?
Doing all right. Could be worse days, I guess. Right?
Yeah, it's been a mixed day for the crew, but we're here now. It's a bit of a highlight of the week at this point, I think, for most of us getting together.
Speak for yourself, but
Okay, well, should we get stuck into the topic of the day?
let's do it.
Let's do it. So we're going to go a bit of a VC masterclass. Hopefully I'm not going to have to say too much because you guys are the men in the arena. But yeah, a breakdown of basically all things VC to take you from hero to zero, or zero to hero even. Oops. It's probably a sign of things to come. Ken, why don't you start with different types of venture capital firm, because obviously they have different focuses depending on the size of checks. That could be seed, pre-seed, Series A.
Yeah. So we'll stick away from industry side, but yeah, I guess it should probably better start between the difference between a fund and a firm. Obviously, sometimes you have some one-offs that it's just that one fund that's kind of running out. Then you have a firm that is actually just housing all of those funds all together. So you might have 1, 2, 3, but then also you might have an opportunity fund or first check fund in addition to that pre-seed or seed fund that you're running. But then breaking out into different type of funds, you could have some that are purely dedicated to the seed stage or pre-seed or very early stage, and those guys, there's a lot more of, dare I say, vibe based, but a lot of them are very founder focused. But that's truly because at that age of company, how much data do you really have? A lot of that data is going to be coming on the experience of that founder, market sizing, which is also an exercise and assumption at times, but you really get an idea of how someone's thinking. You get in Series A, you kind of have a mix of the both. How we talk about in Europe, there's more bankers or consultants that are in the VC space than in the States. That's when you start getting to that mix where you're getting that half vibe base that I mentioned before, but also that next other half of investment banking. And then Series B and above, there's so much data at that point where you're really just running a transaction as you would you're an IB, and the transactions are typically maybe not too far off from the sides depending on the bank you're working at.
Sorry, just to follow on from that. So the sort of later stage you get, the more technical the role becomes in terms of it becomes more like growth private equity.
Yeah, I mean, and you might actually be flexing some of those modeling skills that you pick up. But yeah, I mean, there's a few these early stage companies where I've seen, because I'll say I do pre-seed and seeds. There's a few companies I've seen, they have a full fleshed out model. Like, oh, here's our model for everything. I'm like, this is really nice, but it's also kind of just useless as well. It's good to look at. It's like, and it's helpful to let me understand how you're thinking and what you're looking at. But then it's like, this is an assumption for the next 5 years off maybe a year's worth of data. But yeah.
Okay. Yeah, I think I remember there's a company, maybe like QuantumScape, when I was an auto analyst that did EV batteries. and they basically got to like a market cap bigger than Ford, like 60 billion or something. And their model was just like zero revenue till like 2028. And then like 28 to 31 was meant to like justify this $70 billion market cap. Yeah. And I was like, I don't know, realistically, like you say, what you said is when you're actually trying to underwrite the investment.
Yeah, but you just got to match the vibe. If you believe in 2028, man, then that's all that matters.
I think vibes-based investing is where the industry should go. That sounds more fun.
It's where it's headed.
Yeah.
Vibe-based underwriting.
Josh, do you want to maybe on a more serious note run through, I suppose, as an outsider, the only other way I could think to break it down would be by focus. So maybe B2B SaaS or AI or whatever.
Well, there's many different firms have a variety of investment theses, right? So like ours at QVentures, it's, industry experts looking to solve a problem that they face on a day-to-day basis, right? So, instead of just looking at B2B SaaS, we are a little bit more specific in how we go about that and why. And so when you're a founder, identifying which VCs are the right ones to target, and you'll think, oh, that's right. And then you'll get feedback saying, oh, we're not looking to invest in this. And then you take it personally. And I think that's the wrong way to look at it. Every firm has a different way of looking at investments and sectors. I mean, it can be, even in healthcare, there'll be so many different areas within the healthcare. Your biotech, maybe medical devices, but then even in medical devices, it'll be like robotics. And in biotech, it might just be, even the technology side of biotech, or, oncology right now is a big area too in pharma. So yeah, it really is going to vary. And then same with fund sizes, those will also vary from fund to fund. But yeah, I think there's a lot of different sectors and investment theses. I mean, what's yours at Backfuture?
Yeah, so pre-seed seed B2B SaaS is quite broad.
Yeah.
But I think when part of the screening process is before you can we can commit before a lead, but we'll definitely, obviously we need, it's contingent upon that round closing with a lead. So it kind of saves you a lot of time. But like you mentioned before, it's like there's been a lot of times where I've had founders approach me and I'm like, this is not something I invest in. And it sucks. Some maybe I'm becoming a jaded VC, but you want to help everyone. But it's just like, am I going to take the time to go through the Rolodex and see who's good for this? And like, unless it's like a very compelling thing, but it saves everyone some time, I guess.
Yeah, I think that's a big thing to notice is you get so many applications or founders looking to get investments and will think it's right, and then they keep chasing you for feedback, and then you're like, no, and then they want more feedback, and then ask for further introductions. So it's a bit of it can be tough. So if you're a founder, do your homework.
I suppose. To be fair, I was just going to say, I suppose that's like anything, right? Like we all get people on LinkedIn reach out to us. Can you help me?
Yeah.
Is there any roles going to your bank, or can you help me with my CV? And like you try and help as many as you can, but like ultimately, we were joking before, we're having a bad day, right? Like if I go home after this at 9 p.m, I'm probably not going to want to, start helping someone's CV. I just want to watch an episode of something and go to bed and start again. So it sounds like what you're saying in all this is it helps to have a specialism. And to bring this back to what Matt Spetzler said, who is big time. Big time. He was saying like, it's really helpful to have a specialism because I can't remember how he broke it down. So watch the interview if you're interested. But he said there's a few ways to make yourself stand out and make yourself like really indispensable. One of them was having like a sector specialism. So his was tech or music tech. And it sounds like VC, same thing, right? Network effects. If you're the VC firm that does pre-seed B2B SaaS, then hopefully you get good deal flow. But
it's strange. Sorry, I think you've got firms that are so broad that look at a lot, and then you'll have some VC firms that are so specialized because they've been in that industry their whole lives. They know exactly what's coming out of that specific sector. Or you've got more generalist VCs that will just know, okay, we like consumer because we understand consumers, or B2B. We understand the B2B space really well. So it can really be broad, but you can still have expertise in a broad sector. And then it's the same for more narrow sectors too, or industries.
Yeah, I mean, there's a deal flow perspective there as well, but I think the reason why they would heavy specialize and get those best deals, quote unquote, like that, as you would say, is because there's going to be some idea of portfolio support of some value on the back end of that investment, which is a completely different conversation. I'll just speak it with someone today, and VCs, some of us think we provide more value than we actually do.
Can you, for 2 minutes, just give us your hot take on this? Because I love it.
Yeah, I mean, I don't know. I think
let him cook.
Burn the bridges.
I
This guy's never going to Sequoia.
I think personally, like we provide some type of value, but I think there's some people that think they're pivotal in that journey. Unless you're hoping to really significantly add to the pipeline and making some really significant introductions, which is probably not the case most times, and most founders will tell you that as well, even exited founders. I think that's the biggest thing. Without being too crazy, I just think some people think of themselves a bit larger than they are.
Do you think there's anything wrong in, is it just taboo to say, like, the value added is that you give them capital for equity?
There's nothing wrong with that. I think we all just need to be honest with ourselves.
Okay.
And I think that's probably the biggest issue.
I love it.
Yeah.
I love it. It's a hot take. Moving on from all of us getting banned from our prospective future employers. One thing we did touch on was deal flow. Can you explain, let's say you know what you want to be. You want to be a Series A AI fund. How do you go about getting deal flow, and how can certain firms, your Sequoia or whatever, seem to get the best deal flow all the time?
Well, there's a few ways you can approach it. I think since we're on the topic of Sequoia, I think the biggest thing is firm brand and personal brand. Like, if you're nobody at Sequoia, it doesn't matter. You're at Sequoia, and everyone will pick up a call from Sequoia. If you're at another firm that's like, yeah, it's an all right firm, I might have heard of it, but I haven't really known much about it. Like, there's no, the jersey's not up in the rafter, so to speak. Then that's where personal brand needs to be a bit more important. But if you're, someone that's, fund 1, 2, 3, early in that fund or firm life cycle, that personal brand goes a lot further, and that's really, really where you win the deals. And that's where you might talk about the specialization. That's where you might talk about things you've done in the ecosystem to provide value. So yeah, I think that's probably the most important part of it. But just being a VC, like, that'll get you some good stuff, but then there's a lot more stuff to filter through.
I think from the outside looking in, to anyone who would assume, oh, raise money, I'll take it from anyone and anywhere. I think when you're a founder and you meet with certain VCs, that the deal terms or having them on board as an investor, do you even get on with them? Are there synergies? Are there similar interests? Like, there's a lot more that goes into it than just, okay, they're a VC, they're going to offer me money, great, I want to take it. I've been in roles too, like even at the family office, where we've had a business that we really like the look of and had advanced conversations with, and it was strange. It was still like we were trying to sell why they should want to work with us, right? And it will be the same even for QVentures where I work. Like, there's some great deals we see, and then it becomes a bit of a bidding war. Well, this firm are offering this. Can you meet in the middle, or can you lower this? And then the founder has a lot of the control as well. So it just depends. You would assume, anyone's looking for funding will take the first check that arrives, but actually it's a lot more competitive than you would think. And being able to sell what you can really bring to the table and see where that works for a founder is usually really valuable as well.
That's when you gotta start sharpening the elbows. But I guess that could go both lead and follow-ons. But I'd say also, just for those that might not have the network or trying to get on the radar of VCs, I'll tell you the worst way is to go direct. That is probably the worst way to do it. And it's like, you would think you at least get a call off of it. Deal source is a qualifying factor in the screening process, so that's always like important. I will always make sure I know what deal is coming from where, because then that's something you start to track as well. Yeah, so I mean, I've seen, it's kind of understanding now if it comes to direct, it's not always the best, but it's usually good to get a referral in or something like that.
But the way in which these referrals happen is also quite interesting, I think, to add. So we're in a lot of group chats, deal flow group chats, where stuff gets posted all the time. And us at CF Div Sweeps, we have our own deal flow group chat as well. And that we're able to then share and look at a lot of different deals. I think QVentures, we have an interesting way of doing it. So we have a type form to save us a lot of time, because even if we get referred a company, we make each founder go through the type form, and we've really laid out some important questions for us. If they don't tick the immediate boxes, it's not even worth a conversation, because then it saves us time. So, then that way we're able to look at around 700 plus deals a year. But if you were to do that without a process or a form, it becomes very difficult. Yeah,
we have a type form as well.
Yeah, so it's but I agree. Yeah, there's very rare you'll get something direct. But
the thing is, if you start the day, all right, we have a type form. I want to look at 10 deals. 10 deals is a hypothetical in the out of the type form pipeline, and you have 5 people text you directly, "Oh, you should check this deal out." Your day's going to those 5. Those other 10 could start the next day. Like, that's just how it would go about.
Yeah, I'm not as much involved on that side as you are, so that's more his perspective. But yeah.
Right. Anyway, let's move on to the fundraising and investment strategies within VC. Josh, probably more your wheelhouse.
A little bit more.
Relatively new to the job, but you've taken to it like a duck to water. That's a nice thing to say.
It is.
All right, mate, you suck. You've been doing well. You've told us, you've
raised $250,000 in 3-month period. So it's been good. Riding the wave.
Yeah. You ready to invest in my collapsing house? You want to bail me out from my underwater mortgage?
I back you 24/7, mate.
Thank you. Anyway, right. How do you do it? How do you raise the money?
So I think starting off, VC, the money has to come from somewhere, right? And it doesn't just fall in the laps of some of these individuals. The more experienced, well-networked ones, but perhaps like yours truly of Matt Spetzler, that might be someone who wouldn't struggle raising funds. But I think it will really vary, but the process and how that's done is something I also wish I knew about back when. If you listen to the first podcast, that's sort of how I broke into VC, and it's a separate conversation. But investor relations roles and sales roles in VCs are one where someone is dedicated. It's their job to speak to potential investors, which we call limited partners, LPs, and have those conversations in hopes that they will allocate some of their money into the fund for then the investment team to deploy and then make the returns. So this will vary. I mean, our pre-seed fund is 3 million, so really small, and we'll talk more about the fees associated with that later on. And then now we're also raising a venture debt fund, which is also a whole different ballgame for how you go about raising that sort of money. So like my day-to-day with it being a smaller fund, and anyone who is wanting to break into VC who's more commercially minded and more outgoing, wants to be client facing, this is a great way to break in, and especially if you've got sales experience and success in previous sales roles. But yeah, so day to day is a lot of business development, reaching out to existing LPs, so investors that have allocated capital in the past and might allocate again to the funds. I mean, ours is a 3 million fund, it's quite small, so raising for that isn't as, arguably some might say it's difficult compared to larger funds. But so I'm chasing like 50 to 200K tickets from individual investors, right? So it's really building relationships with these investors over time through various different outlets. So starting the job, it's just reaching out to existing investors who are looking to potentially allocate again. So I will call them up, introduce myself, say, look, I'm new. I see you've got in previously. Is this something you'd like to do again? Some will say yes, some might say no. I need time to think about it. And you're just building that up over time and creating a pipeline. So since joining, giving you an idea, our CRM has got like 7,000 investors. About 1,000 of them are active. And then I've really, in the pipeline, I've got 250 people. So those are individuals I've actually spoken to. had a conversation with. Some might say yes, some might say no, contact me another time. And then for larger funds, that's quite interesting. So I'm also supporting with the venture debt side as well. It's not my main focus, but it's pretty exciting nonetheless. So that'll be more through family offices, where we're targeting bigger ticket sizes. Even especially for our pre-seed fund, we actually talk to smaller IFAs, for example, to have a tax offering. So, I mean, there's so many different avenues we can go, but I think starting off, that's what goes into investor relations and how it's structured, really.
I think to put it slightly bluntly, like Ken, I know when you built your reputation, there was a lot of like pounding the pavement. You were at events like more than one a day. You were going to, afternoon events, evening events. And I think sales is similar. Like you have to go to networking events, you have to do cold outreach. Like when I joined Barclays, put bluntly, like it was a bit like I was new to London. I didn't know anyone. I didn't know you guys when I first moved here. And just cold emails, cold phone calls, picking up stale leads. Like it's a little brutal. It's a bit of a grind when you first join, right?
Do you know, it's funny, like I've sold products, and then now it's a product, but it's not a physical product. It's selling someone an opportunity for a return.
A dream, if you will.
But it's quite interesting. I'd say probably I can count on one hand of how many people have told me to get lost, in a polite way. People are usually really receptive to a call of, I'm Josh calling from QVentures, venture capital firm specializes in early stage tech investments. They're like, okay, sounds interesting. Tell me more. Because it's also, I'm targeting individuals who are ultra high net worth earners. So they've got money. They understand the importance of deploying their capital in various different areas, diversify their portfolio, et cetera, et cetera. So I think when you're doing the cold outreach, goes even back to finding the right VC who's going to back your company. It's like, do your homework. Who really might be interested in something like this? So, and then it's a better targeted approach.
And a lot of the people, like certainly I reach out to, like fortunes basically. Yeah. And they're professionals. So they might be MDs at an investment bank or traders at Wellington or whatever. And so they're unlikely to tell you to get lost. Yeah. They kind of respect what you're doing, but it's still like you say, when you walk in and you see the CRM and they're like, here are your leads, and you're like, we haven't heard from this guy in 4 years, and it's like, well, we're gonna have heard from him in the next week because that's your job. So but once you get the network, you pay your dues, and then you get the network, it becomes much more fun, right? Because now you're at a point where you can say, hey mate, do you want to have a hit of tennis? I've got an opportunity, and you can kind of make your own deal flow in a much more fun way. But
then also you kind of know where your pipeline's going and where it's coming from, which is exciting too. So,
and I was going to say, within that, how important you said IFAs, do you do partnerships with, like I said, big banks, wealth management firms, where you get on our recommended list? So we have a research analyst that covers it, does all the due diligence, and then basically gives it to the sales team to basically say to the clients, like, hey, this is something we believe in. We think, you could make X amount, you should invest.
So for our venture debt fund, actually, we're speaking to two larger private banks, nothing like Barclays or Julius Baer or anything on that level, but they are kind of looking at it as an alternative investment mandate for their clients. So, and then for smaller IFAs, they're going to want different offerings for their private clients as well. So, there's one individual I played tennis with, got his own IFA. It's like, okay, well, you've got 50 clients. Here's just another string to your bow, really, that you can give them an offering for. So
nice.
Yeah.
Ken,
I was just going to ask, do you see a lot of that? I mean, I know Barclays is pretty strict, but for private markets, or is it?
I don't really do the fundamental research side anymore. Okay. So like my old role of probably like looking into stuff has died down a bit. I do, because I want to keep hold of the skills, and also just from like a relationship point of view, I want to try and give my clients like the best thing, because it's best for them, and selfishly it's best for me, right? Because then I win their trust and they probably give me more assets. So I do sense check everything that gets like approved by the bank, and do my own diligence on it. But aside from sort of taking it home on the weekend before I sending it out to clients, like I don't really get involved in all the sort of like external stuff. Like
Makes
I
sense.
just kind of trust our process because it's big bank, right? So you've got to have faith in your team. I did want to go through the fundraising side from the startup point of view. And Ken, I think you're probably best placed to do this because you've obviously been at 2 startups, but you invest in them. So you must sort of have advice for the founders who are raising.
Yeah. I guess from the fundraising side with startups, it's there's a few ways to look at it. I mean, I know there's a few where it's just that actually need to just look into it first, like maybe just do a quick Google search on how these things structure out and what to expect. There's been more than a few times, which is fine. I understand first-time founders, they've never done it before, but if I ask you, what are your plans for a lead investor and you've never heard of that term before, it's kind of like, okay, well, this is probably gonna be a very long process, or I don't want to say it disqualifies, but it kind of makes it a bit of a harder sell. But yeah, if you're gonna want to know how much you're raising, why you're raising, what milestones you're setting for yourself. There's a lot of cases where that's not really known by the founders I've seen. Well, not all of them. I shouldn't say all of them, but like I think there's a small percentage. And then have an understanding of why you want an investor to be on the cap table. And also understand, you're probably going to want to have some traction before, not from a commercial standpoint, but maybe if you could bring some business angels on the cap table before. Because you can tell these founders, or the VCs, we've raised from X amount of capital from, you could throw out a name if you want, if it's someone that's worth knowing. That's why the biggest part of it, making sure you have 18 months, what are the commercial milestones you're setting yourself to, and, kind of setting them against each other as well in terms of VCs. Everyone loves a bit of a sharp elbow fight, but also being transparent. That's one thing that if you're not transparent, that will really drag on the process more than it needs to be dragged on, which, time kills all deals as well. So.
Yeah. And is a pitch deck still sort of like the ultimate, or is that sort of died down a bit?
No, the pitch deck is required. I mean, there have been times where founders have said, I would like to pitch my company. I'm like, is there a pitch deck? And if there isn't, I'm like, then there's no, like, in the politest way possible, there's no reason for us to call. If there's someone that's like putting something together and just trying to figure things out, I'm more inclined to have a call on that versus I need a pitch deck. And usually what I'll do is I'll say, like, you don't pitch to me, during this call. I don't want to be pitched to. You don't want to pitch during 30 minutes or 45 minutes. So just give me that. I'll take a look at it. We'll have an informed conversation. And that's where we kind of get into this whole thing of, how do you vibe with the VC or the investor and make sure that you actually align with what they're doing outside of what they invest in on a typical basis. And
is it a red flag if they sort of just reach out to you out of the blue, no mutual connections? If you're a startup, can you just Google, if you're based in Cambridge, which is like a sort of science tech hub, like, Cambridge VCs, and just reach out to them on LinkedIn, or should you have a network?
It's not a red flag, but it's just the game. It's just the game. So it's like, I respect the game for doing that, but you should probably play it better and say, try to find someone that knows someone and get through that route. Or, some people do very well at building up their own profile on things. There's one company who I will not name, who did a very good job of getting some really good publicity for themselves of LinkedIn posts. They kill it, had a really strong pipeline of customers of which type I will not tell because I'll probably tell you who it is. It took so long, and then the terms they were talking about were just so out there, and a 1 mil on 10 mil. I'll post money. I'm just like, dude, what are you talking about for a pre-seed? And it just got really messy, and I was just like, yeah, I'm just gonna take a step away. And also for never ask a VC to sign an NDA. That's a waste of everyone's time. I've had that a few times, and I'm like,
VC is likely not gonna steal your idea. They are not,
really don't care. Really don't care at all.
No.
Not even at pre-seed.
Because the thing is, if I wanted to found a company, I would be a founder. You wouldn't be reaching out to me for an investment. I wouldn't be an investor if that was the case. It's a logistical hurdle that no one can enforce it. How are you going to track that? sometimes there's time frames on there that just don't make any sense. Like some of them are like, oh, for the length of the round that before they close it plus 12 months or something like that. And it's just like, dude, no, we're not doing that. Because then what if it comes out we invest in one, you're gonna come sue? No. But that's also not to say that VCs are also like the most efficient all the time or are completely on the ball all the time, because it's a two-way street, right?
Yeah.
So that's also
there's
a lot of good founders that work really hard and really hustle hard.
Understanding roles within a VC. Josh, given a fairly comprehensive breakdown of IR/sales, so we'd probably leave that one. Just would be helpful to know, and I guess the answer will be it depends, but on the sort of deal side, do you have like an analyst? Do you have like a partner that makes decisions?
There's two people at my firm, and I do I've touched everything, right?
I know, but in a more traditional, I suppose, so in my world, right, you normally have a research analyst who just does research. You then have like a sales team who does sales.
No, that's not saying I don't know. But what I'll say, so to answer the question is like, it's typically like standard, like I guess most interesting, like if consultancy, right? You'll have, like you said, your analyst, your associate, yada yada, move on and on like that. So yeah, it's pretty much the same, right? Even in the time scale, right? 3 years, you move up, and that whole thing. There's some interesting places in the VC space, some funds which I will not mention. There's a phenomenon of like everyone will be a partner. So externally, everyone will seem like a decision maker. And because the reason for that is most founders that are worth their salt, have been around the block a few times or at least once, will know that if you speak to an analyst, it's a very long road versus if you're speaking to a principal or up. So if everyone's a partner, you don't know who the decision maker is, and that it's kind of a smokescreen in that regard. But they're definitely not a partner when it comes to internal operations. There's a few others that I've added the VP role, which has been an interesting one, but that's more just kind of like another stepping stone in the ladder of that career process.
And I suppose it works a bit like investment banking, where the juniors do the modeling and the quote unquote grunt work. And then there's sort of principles. Do you lose some of the technical skills? Or not lose them, but they become less relevant, and it becomes more like networking and deal flow and client relationships and stuff.
I'd say in a lot of ways that would probably be closer to what would occur maybe Series A and above. I would say probably at pre-seed and seed, it's more of a SDR situation. Like, so you're really just like pounding through leads, he's scraping through LinkedIn, or someone's in stealth, you reach out to them, or someone's done someone reputable at a good company has moved into something. They've said, oh, now they're in stealth, or they're saying something new, so you're gonna touch base with them and see what's going on.
Explain stealth. Is that just building in quiet?
Yeah. So basically, there's a thing on LinkedIn where you could do your next career post like in stealth, which it's just signaling. Like in VC, everything is signal in a lot of ways, and do these signals build enough conviction for us to write a check? That stealth is probably a signal enough to at least put it in the pipeline, depending. But yeah.
Josh, anything to add on that side in terms of QVentures?
Yeah.
Have you seen like corporate structure? I suppose I've always been in quite rigid corporate environments where you have this defined progression.
I mean, if you're a big VC firm, there will be some corporate structures. I mean, I remember I was interviewing with one at the beginning of the year, and I was sent a case study, and it was very formal, and the role was very much explained of what you will be doing, and then the more senior individuals will take care of the negotiations, the conversations. You'll just be doing a lot more of the grunt work,
the dinners.
But it's just different. I think when you get a role at a big firm, it's great. It's respected. It's a real chip on your shoulder. And then at smaller firms, it may not have the same impact on your CV, but it definitely, you will learn a lot more, and you will get immersed into the day-to-day more so than you would at a larger VC. And that's just depends what you prefer, really. Salaries also at the larger VCs will be a bit more because the management fee, because the fund size is bigger, there'll be more money to be dished out. But in QVentures, so for instance, there's 9 of us. It's 3 of us are, so my boss is a partner. He's kind of head of, raising capital, investor relations, distribution, you name it. And then it's myself and my colleague with the same level, associate. He was an ex-founder, which is interesting. And he raised $500K for his business, Goldling Drinks. And he just wanted to get into VC and see it from the other lens. So, but he's really commercially minded. And then we've got associate on the investment side. And then we've got a portfolio manager who's been there 9 years, and then an investment partner, and then just like a few others as well who are going up, some chipping and changing here and there. But it's a little bit more structured, but still quite, I'd say, spread. That makes sense. Okay. So because I want to, here's another thing, like even if you want to get into VC, but you may not want to raise capital for forever, I think it's a really important skill to have, because if you ever want to start your own firm one day, you got to know how to do that, how these conversations are structured, where you're going to find these people. But then I'm now wanting to do some more of the investment side a little bit. So when you're at a smaller firm, there's a lot more, more needs to be done, and there needs to be more help. So, I'm working a bit harder, but it's something I want to do and something I enjoy doing. So I don't mind that. And I'm actually looking at 2 deals as well, writing a couple of the memos. It's cool. So to summarize, big firm, more structure,
more defined.
More defined. Yeah. Definitely tougher to get into. Like there will be credentials that will be needed.
Yeah.
And then for smaller VCs, it's a bit more fluid and
all hands on deck.
Pretty much.
Yeah. Okay. That makes sense. Is there a difference? It's something I see a lot, and I don't think I've ever fully understood, if I'm honest, in terms of how a firm chooses if they lead deals or follow on from deals. Is it just a function of size? Like if you're a big firm, big resources, you write big checks and you take the responsibility of dictating the terms and everyone follows on?
I could also touch upon this.
I mean, the thing is, it's a function of fund size, right? Because as we might have mentioned before, smaller funds are able to perform because it's easier to, you don't need that equity target that a larger fund would need to kind of make that hurdle of exceeding the actual fund size itself of assets under management. So typically whatever the fund size you have, if it's a larger one, then you have to have a minimum equity target, which means you need to pay X amount to get into the deal itself. Because obviously, because we come back, the founder said, okay, well, we need this amount for 18 months runway to hit these milestones, right? So then they'll say, okay, well, if you want to get this amount, we can, our check size, ideal check size is this much, so we will get this amount of equity for this much, and then we're effectively leading it. Usually they're doing most of the round for that. So it's really just kind of just a function of that.
Do you guys lead? Yeah. No. Okay. So it's interesting. So QVentures. So we typically actually like to lead a pre-seed.
Oh, really?
And we're quite strict in how what our terms are. So they're not afraid to lead, and then we typically take a board seat, and then if any of the companies look to spend 10 grand more than what they have on their business plan, they have to get approval from us. So we're quite involved when it comes to like the investments.
That sounds very involved. 10 grand.
No, but the reason, because my managing partner, he said that a lot of companies, especially pre-seed, they always need more money. Which eventually that does happen, but of a 500K round, we're not afraid to lead, because then we can set the round. We get a board seat, and then also we make sure that a company has 18 months of runway.
Why it makes sense to really understand how much money you need.
Yeah, and that's something that when it comes to adding value, I guess the seniors on our team understand quite well, because they've seen it when companies haven't had enough money and understand really what types of businesses are going to need more money than others. And yeah. So it's interesting.
I think I think to be fair, I think that's quite nice that you try and add value in that way, being like, it's obviously, I'd imagine, a bit restrictive in a sense, but it's helpful if you're a first time founder, especially. You've got this big budget to have someone sense check you and be like, do you actually need an extra 20 grand on marketing? Where's the ROI here?
A lot of our first time founders, or a lot of our founders aren't actually past previous founders because they're industry experts, right? So they would have worked in a job for X amount of years, and realize, okay, there's a problem to be solved here. I'm going to try and do it. So they don't necessarily understand.
Yeah, I suppose it's different in a corporate world. The budget is fairly known in advance, and I suppose you don't have the same direct pressure as you do when it's your company, right? Like, you might not break things down as detailed as you would when this is literally what's going to potentially feed your family or not.
But the reason, especially with the 10 grand outside the business plan, because when founders raise their money, they get excited and there's a conference and they want to spend 40 grand on a marketing stand, and it's like, that's not an important thing to do right now, but they think, oh, it is, because we're going to get exposure and it looks sexy and it's nice, and
it's a sense check.
So that's why we have these mandates in place. But
one other thing that would be good to explain would be follow-on investments. Do these tend to happen at larger funds where the need for capital is greater, or can they happen at all stages of the venture capital spectrum?
It really depends on the fund itself. Some would have that opinion. They'll leave a reserve to follow on, just kind of protect themselves from dilution. But then at the same time, it's like those are your winning bets as well. But yeah, usually the idea is to just make sure you're not diluted out too much, because you can lose up to 50% from the time of investment as seed by the time you get to that exit portion
through dilution.
Yeah, but then if you have an absolute winner, you could say, okay, we need to not only protect ourselves, but maybe increase the size of equity we have in the deal.
In terms of evaluating a VC fund's performance, run us through some of the key metrics in terms of, do you look at the fees? Do you look at the track record of the manager, etc.?
Well, I think those would probably be before any funds are committed, from the track record and the
fee structure.
The fee structure, but I mean, most would be a 220 unless. Yeah, I think there was one story I heard of. It was like 3.5%, but they also reduced the upside they had at the end.
So sorry, 2 and 20 is still industry standard, because in the hedge fund space, I think we said this before, but hedge fund space it's been compressed.
Yeah. So in the VC space, 220 standard. I mean, you might get those outliers, of course, but that's with anything. But yeah, I think there's like top 4, right? You have IRR, TVPI, DPI, and then you have MOIC.
We'll come on to this.
Yeah.
All right. Before we go into evaluating the performance of a VC fund, it's worthwhile probably going through the structure in terms of fees, performance fee, management fee, and also just the life cycle of a VC fund.
Yes, I mean, I guess let's start from the top. Standard VC, usually life cycle 10 years. Some will extend to 13 depending, but I think you've probably seen more of that in these last cycles as there's less exits in the market and things of that nature. But so typically you'll deploy over a 3-year period. At the end of that, they'll probably start raising the next fund. But then after that, you're looking, hopefully having exits in 5-7 years. But as I mentioned before, you're seeing those extensions into above 10 years of. But then you have those few funds that are kind of evergreen, where they're always just taking in capital and deploying it out. Maybe that's probably more on the SEIS side, startup investment scheme if you're not in the UK. And yeah, usually they'll run on a 220 fee schedule, so 2% of management fees, which will go across the side, all funds committed. So if, for instance, you have a 10 mil size fund, you'll take 2% of that just to keep the fund operating alive
each year.
Yeah. And then, but it will usually taper off towards the end. Okay. You'll have the 20, of which I cannot even remember the name of the other one. But basically, the 20 in the 220 is you'll take 20% of the
performance fee.
Performance fee. Sorry. Yeah. So 20% of the performance fee. Basically, you're just taking the upside of all the profit that the fund produces, And obviously that's after you get through the hurdle rate. So you're producing, so if you have 10 mil, you surpass 10 mil in what you produce in exits, and then you take 20% on top of that. You do have some that might get a little crazy about it, and they're like, oh, well, we're hitting this winner, we got this winner, and then, let's say you hit 9 mil, but you've taken 20% of that, but then you don't hit anything else. So that means there's a clawback, and you might be liable for what you've taken and maybe some more of that, depending if you haven't reached that.
Right.
But
Sorry. So just to break it down very simply, excluding the management fee, because that's an easy 2%, you raise 10 million. You, at the end of 10 years, you return 20. So that's the total return. So you give the 10 million back to the investors to make them whole. And then there's 10 million left over. The VC firm keeps 2 and the investors get 8. That's the 220 explained. Yeah,
exactly. Okay.
And that's, like I say, it's interesting.
Well, you say investors, just to clarify, the investors being the LPs and the VC being the GP, just LP GP split. Yeah.
Because, it's a good point, because a lot of these funds, I suppose the firm itself, the GPs would have 20-30% allocation in the big funds at least.
Nah, probably not. I like 10% is probably a good place to be. But then again, like, it really depends how they're structuring that out. But that's why you guys kind of get the difference between the firm and the fund.
The next thing I want to touch on is when you evaluate a fund's performance, there's a few metrics that are sort of repetitively used, both in PE and VC. Josh, do you want to go first with your favorite metric?
Sure. So IRR, so internal rate of return. And that's usually like forecasting the annual returns due to like the cash flow of the business. So thinking ahead of like, okay, well, this is where our fund is performing. It's at, a good IRR is around 20%, which means that's what you hope it's going to be performing towards the end of the year or when we exit the investment. So when I'm talking to investors, I'll say, right, like, our fund is at, X IRR, like, how does that sound? They say, oh, that sounds great. Sounds like an attractive metric. But that's something that a lot of investors will be aware of. And the more technical ones will know about TVPI and DPI.
Just to say on yours, IRR, I think it's like the handy textbook one, right?
Yeah.
Because it's very, no matter who you're talking to, hedge fund manager to someone who just inherited 20 million and is figuring out what to do with it. You just say to them, hey, you gave us your money for 10 years. Your IRR is 17%. Yeah. So on average, you made it like a compounded rate of 17% each year. And it's just very easy, very scalable. But Ken, you've got a different one.
Yeah, TVPI, the total value paid in. Basically, it's just very, very nice way of saying this is the appreciation on paper. Just like if you're trading, if you haven't really exited or if you exited your position, it's just there on paper, appreciation. It could get pretty interesting. I mean, obviously, if you invest, for instance, if you lead around at pre-seed, right? But then you lead the seed, I mean, you've appreciated on paper, but it's a bit of a dodgy and then maybe a disingenuous appreciation because it depends who agrees on it. Your follow-on investors agree with that, but does the market agree the same way? But yeah.
Well, that's why I chose DPI as mine, so distributions to paid in capital. And that's basically just because a lot of people have that attitude that they don't want to count it unless it's returned to them. And
I get that.
Yeah.
I get that a lot. Yeah.
Common pushback. I get it. Like I do get it. There's 2 ways you can explain it. The jokey way, which is like we often get pushback when you're quite young, like in your 20s in finance. People are like, I'm 70, I've been around the block. Like, a bird in the hand's worth 2 in the bush. But then you also get the hedge fund managers, the PE guys who will be like, I don't really know if I trust market marks at the moment. I actually think I'm looking at this and I'm looking at the cycle and I think marks could go down and, there's room for some of these like, mark to market marks to basically go down. And so for that, some of that estimated return to fall. And that's quite like a tough pushback because it becomes more technical and you have to really like sort of hold your ground. But yes, it's DPI is good because ultimately it shows if you got a DPI 2, right, you made 2 times your money, but it's very lagging. So your IRR might be 25%, your TVPI might be like 3 times, and your DPI could be like 0.3 because you haven't actually had any of the money back yet. So it's a tough one to defend, but I think it's important because it's
VC can be funny like that.
Yeah, that's kind of the whole issue with the industry now that we're seeing. You have all these, VC funds that are having like really good TVPI, but they haven't produced DPI in a very, very long time, and that's becoming a real issue. And it's even become more of an issue when you have some of the portfolio companies doing markdowns because they're running out of their runway, but they need cash in. So they're literally just going about, okay, we're going to raise at a lower valuation, which kind of just throws everything for a whack. Yeah. But there's been a lot of pressure from the LPs on, how you're going to start exiting out, which is why we had that secondary conversation and why it's becoming what it is today.
But that's what 22 did to the industry, right? Because people didn't want to do a down round because, I don't know heaps about VC, but I know that's kind of like the kiss of death. And so they were doing like these weird, like up rounds. So you were like, 50 million last time, you're now 50 million £1. Yeah. But like the preference stack just got absolutely obliterated. And people doing all sorts of things to basically bail out. So that was another one, just doing like a continuation fund to bail out the last fund.
Yeah.
So many financial sort of engineering metrics, which is, I suppose, where public markets differ because if your client's down 30% on the year because they're in some high beta sort of pre-profit tech company, I won't name any of them, but it's you can't mask that.
Some would say as long as you haven't hit zero, there's still hope.
I want to do a sort of quick fire round just to finish off. So maybe some tidbits we didn't quite cover. One would be, could you explain the difference between pre-valuation and post-valuation when doing a round?
Yeah, pretty straightforward. Pre-money is basically the value of the company that you have all agreed to. And post-money valuation is that valuation plus the money that you're investing. That's it.
Very easy. Capital calls, Josh.
It's a very good question.
Administrative pain in the ass sometimes, but very important.
I see that vein popping.
Our survey said.
For our fund, right, we do it in 4 drawdowns.
Oh, okay. So you do it. You don't do it ad hoc. You do
no,
it.
But it's pretty standard. Is 4 drawdowns is pretty
so
common.
then we'll have a capital call like every quarter.
That's how you save your IRR.
See, I have. Okay, let me touch on that. I'll give it how I thought this was going to go.
Okay.
Which is, I'll just basically tell you what happens for me.
Yeah, please
I have a client who's got 20 million in PE across like, 10 different funds or whatever.
Yeah.
And like every 3 weeks on a different system, because there's no sort of universal API, it's like you need to send, 30 grand here because they're doing an investment, or you get a USD distribution, right? So 100,000 comes in, and then 2 weeks later they've got a 50,000 euro capital call, and basically I have to just keep sending money around. And I thought that's how the industry worked. I mean, but apparently it's moved on.
If you it depends on the fund. Some will just some that wouldn't care about IRR. I mean, but like you can literally some will let you just pay out. Like if you are committing 10 grand, for instance, you could just pay the 10 grand. You don't have to wait for them to call it sometimes. But if you but then does everyone want to just put out 10 grand at one point, or would they rather just do the 2,500 every time there's a call? It's really just some that's on preference depending on the fund as well.
Okay. Why does you said something about saving IRRs? Why does one help IRR v the other?
No, I mean it's just I think it's a vanity metric sometimes, but it looks good because obviously the money's compounding on itself and it's producing out versus the money you take in, right? So people's like, oh, like we gave you this amount of money in X period of time and you produce this versus us, giving you 100K up front and it took you all this time to just produce it out. It's really just how long you're holding the cash, right?
Yeah. All right. Next question. Saw a stat that said first-time funds perform better than follow-on or continuation funds, like later, the second fund, the third fund. Why?
Most value is created at the seed stage.
Let him cook.
Yeah, that makes sense. Fine, I'll give you that.
Yeah,
easy.
I mean, like if you really think about it, right? Like, yes, you could be diluted out 50%, like I mentioned before, but at the same time,
de-risk.
If you invest in a company that's doing like a 3 or 4 mil seed, but then they do they double out on the Series A, and then the Series B is obviously going to be a larger multiple of that. You know, kind of just does it to itself, you know.
The next stat I saw when doing my research, smaller funds do better. Again, I'm assuming.
Well, it doesn't take as much to get a return.
Law of large numbers. You've got more opportunities.
Yeah, but I mean, like even in our fund, right? We've got 12, we're on fund 3 now, 12 companies. If you have one that we get in at like 1.2 million valuation, if one just generates $1 million in revenue, pretty much, you know, made the fund. So it's like, in the likelihood of 1 out of 12 generating $1 million revenue, well, we've got 4 in fund 1 that are doing that.
Well, it's a lot easier to double 1 million than 100 million. Boys, you both work in VC. Anything else you want to add before we wrap it up?
It's a great industry to be in, especially now, I think, because there's so many new exciting companies coming through.
For what it's worth, I agree with you. I think there were a bit of an issue with the whole Marks 21 bubble, 22. I think that's playing out. You've got this tech revolution. The Marks have reset. On a private client side, I think like the affluent are doing well. So there's the ability to fundraise. I think it's an awesome time to be a VC. All right, I think that's us for the day. Enough of the podcast. But if you want to catch us, do reach out to the group, message us on the page. Lots of exciting things coming up with rumors of a couple of big summer parties on the horizon. So it would be good to get everyone along. Thanks, boys.
Cheers, mate.